The subject of decoding payment terms and milestone triggers is foundational to the practice of surety bond underwriting, as it requires a precise understanding of how financial flows within a construction or service contract impact risk assessment and bond liability. Payment schedules serve as the backbone of contractor cash flow management, influencing everything from project execution to claim probability. Historically, payment terms have evolved from simple lump sum payments to complex milestone-based structures designed to align compensation with measurable project progress. The shift toward milestone payments, while ostensibly reducing risk by tying disbursements to completed work, has introduced its own set of challenges, particularly when terms are ambiguous or inadequately vetted. Understanding payment schedules. A detailed breakdown. At the core of payment schedules lies the need for clarity and enforceability. Early payment discounts, often used to incentivize timely settlements, can present hidden risks for sureties. While these discounts may improve cash flow for contractors, they can strain subcontractor relationships if payments are expedited without sufficient liquidity planning. For example, a contractor utilizing discounts to secure a financial edge might inadvertently delay payments to their downstream partners, creating friction and increasing the likelihood of performance issues. Retainage terms, typically holding 5 to 10% of contract value until project completion, serve as a financial safeguard but often become a double-edged sword. While retainage incentivizes contractors to finish projects, it can severely limit their working capital, particularly on large or long-term contracts. Surety underwriters must evaluate whether the retainage amount aligns with the contractor's financial stability and whether excessive withholding could push the contractor into insolvency. Penalty clauses further complicate the landscape, particularly in contracts with strict liquidated damages provisions. These clauses, which impose predefined penalties for delays or breaches, must be carefully assessed for proportionality and enforceability. Disproportionate penalties can destabilize even well-established contractors, creating cascading financial stress that elevates bond claims. For example, in jurisdictions where courts are unlikely to enforce punitive damages, overly aggressive clauses may invite disputes, delaying payments and project progress. Sureties must analyze not only the penalty amounts but also the mechanisms for assessing and resolving disputes, as these factors directly influence bond liability timelines. Red flags in milestone-based payment structures. Milestone-based payment structures, while ostensibly designed to ensure accountability, are fraught with potential pitfalls. One critical issue arises from poorly defined milestones, where the scope of completion is ambiguous or subjective. In such cases, contractors and project owners may dispute whether milestones have been met, resulting in payment delays that can disrupt project timelines and cash flow. Another red flag is the misalignment of payment milestones with project cash flow needs. For instance, a schedule that heavily backloads payments might create liquidity challenges during early project phases, forcing contractors to rely on external financing or personal reserves. This not only increases the contractor's financial burden, but also raises the probability of defaults, particularly in industries with slim profit margins. Sureties must also scrutinize the timing and sequencing of milestone payments. Payment triggers tied to external approvals, such as regulatory inspections or third-party certifications, can introduce delays beyond the contractor's control, creating a mismatch between expected and actual cash inflows. Additionally, milestone schedules that fail to account for seasonal variations or supply chain disruptions can exacerbate cash flow risks. For example, in projects reliant on weather-dependent construction, payment milestones tied to fixed dates may create undue pressure on contractors, leading to rushed or subpar work and increasing the likelihood of bond claims. Techniques for reconciling payment schedules with financial health assessments. To mitigate these risks, sureties must employ advanced techniques to reconcile payment schedules with contractor financial health. This begins with a comprehensive review of the contractor's balance sheets, income statements, and cash flow projections, focusing on liquidity ratios, debt service coverage, and working capital adequacy. Contractors with strong liquidity and minimal short-term debt are better positioned to navigate delayed payments or unforeseen project expenses. Conversely, Contractors operating with razor-thin margins or high leverage may struggle to sustain operations under restrictive payment terms. Integrating contract analysis with contractor financial assessments involves mapping payment schedules against projected cash flows. This process requires an understanding of the interplay between payment timings, operational costs, and external financing needs. For instance, underwriters must evaluate whether a contractor's reliance on lines of credit to bridge cash flow gaps introduces excessive financial strain. This is particularly relevant in environments with rising interest rates, where financing costs can rapidly escalate, eroding profitability and increasing default risk. Historical context and theoretical frameworks. From a historical perspective, the evolution of payment terms reflects broader economic and legal shifts in risk allocation. The rise of milestone-based structures in the late 20th century paralleled advancements in project management methodologies, such as critical path analysis and earned value management, which enabled more precise tracking of project progress. These frameworks, while instrumental in improving accountability, also created new opportunities for disputes over milestone interpretations. Theoretically, the principal-agent problem provides a useful lens for understanding the dynamics of payment schedules. In this context, contractors, agents, may prioritize short-term gains over long-term project success, particularly when payment terms incentivize cutting corners or delaying non-critical work. Interdisciplinary connections and contemporary debates. The intersection of finance, law, and project management highlights the interdisciplinary nature of payment terms analysis. For example, legal principles governing contract interpretation play a critical role in determining the enforceability of payment schedules, while financial modeling techniques enable more accurate assessments of cash flow risks. Contemporary debates often center on the balance between flexibility and enforceability in payment terms. Some argue that rigid schedules stifle innovation and adaptability, while others contend that excessive flexibility invites disputes and undermines accountability. Emerging technologies, such as blockchain-based smart contracts, promise to address some of these challenges by automating payments based on predefined criteria, reducing ambiguity. Change order clauses represent one of the most critical components of construction contracts, serving as a framework for managing alterations to the original project scope, timeline, or budget. These clauses are not mere administrative tools. They are foundational to understanding how deviations from agreed-upon terms impact the financial and legal obligations of all parties involved, particularly the surety underwriting the bond. Change orders can arise from unforeseen circumstances such as design flaws, site conditions, regulatory changes, or client-driven modifications, and the terms governing these changes significantly influence the scope of bond liability. A thorough analysis of change order clauses requires an advanced understanding of their processes, including authorization hierarchies, notification requirements, and the nuanced interplay between contractual obligations and financial risk. At the heart of change order management lies the process of authorization. Most contracts establish a hierarchy of approvals to ensure that changes are reviewed and sanctioned by appropriate decision-makers before implementation. This hierarchy is designed to protect both the project owner and contractor from unauthorized modifications that could escalate costs or disrupt project timelines. For example, a typical structure may require project managers to initiate the change order, followed by review and approval from senior executives or external consultants. For surety underwriters, the degree of clarity and rigor within this hierarchy is a key indicator of risk. Ambiguous or poorly defined authorization processes often lead to disputes, as contractors may proceed with unapproved changes under the assumption that verbal agreements or informal approvals are sufficient. This lack of procedural discipline increases the likelihood of claims, particularly when disputes escalate into litigation. Notification requirements within change order clauses are equally critical. These provisions outline the timing, format, and content of notices contractors must provide when requesting a change. Effective clauses ensure that changes are documented in real time, capturing essential details such as the nature of the modification, its cost implications, and the expected impact on the project timeline. From an underwriting perspective, these notifications provide a paper trail that can be invaluable in assessing claims. However, lax or overly complex notification requirements can create significant challenges. For instance, contractors may miss deadlines for submitting notices due to bureaucratic delays, rendering their claims invalid under strict interpretation of the contract. Such situations often result in stalled projects, with the surety caught in the crossfire of competing interpretations of contractual intent. Scope changes introduced through change orders have a direct and profound impact on bond risk exposure. Every modification to the original contract introduces new variables that can destabilize the delicate balance between project resources, contractor capabilities, and project owner expectations. For instance, a significant expansion of project scope may exceed the contractor's operational or financial capacity, leading to delays, quality issues, or outright default. Similarly, scope reductions, while seemingly advantageous in reducing project complexity, can trigger disputes over lost revenue or altered timelines. Surety underwriters must evaluate these changes holistically, considering both immediate and long-term implications for project viability. This evaluation often requires collaboration with legal experts, project managers, and financial analysts to identify potential vulnerabilities and mitigate exposure. Historical context sheds light on the evolution of change order clauses and their role in bond liability. The rise of modern construction practices in the mid-20th century brought increased complexity to project contracts, necessitating more sophisticated mechanisms for managing change. Early change order clauses were rudimentary, often relying on informal agreements or ad hoc adjustments. However, as projects grew in scale and complexity, the need for formalized processes became evident. The introduction of standardized contract templates, such as those developed by the American Institute of Architects, revolutionized the industry by providing consistent frameworks for change management. These templates emphasize the importance of written agreements and detailed documentation, laying the groundwork for contemporary practices. From a theoretical perspective, change order clauses can be analyzed through the lens of contract law and risk management theory. In contract law, the doctrine of good faith and fair dealing is particularly relevant, as it underscores the expectation that parties will negotiate changes in a manner that respects their mutual obligations. In practice, this doctrine often collides with the realities of construction projects, where competing interests and tight timelines create friction. Risk management theory further elucidates the challenges of change order clauses by highlighting the tension between flexibility and control. While clauses must be flexible enough to accommodate legitimate changes, they must also maintain sufficient control to prevent abuse or mismanagement. Practical applications of change order analysis involve dissecting case studies where poorly managed clauses led to disputes or financial losses. One illustrative example involves a project where the contractor implemented a series of verbal change orders without obtaining formal approval. When the project owner later disputed the validity of these changes, the lack of documentation resulted in costly litigation and a bond claim. Another case study involves a contractor who submitted change order requests well beyond the notification deadlines outlined in the contract. Despite the legitimacy of the requested changes, the project owner's refusal to honor them created delays and financial strain, ultimately triggering a performance bond claim. These examples underscore the importance of procedural rigor and documentation in mitigating disputes. Interdisciplinary connections further enrich the analysis of change order clauses. Insights from behavioral economics, for instance, reveal how cognitive biases influence decision-making during change negotiations. Project stakeholders may exhibit optimism bias, underestimating the cost or complexity of proposed changes, leading to unrealistic expectations and subsequent disputes. Similarly, principles of organizational behavior shed light on how communication dynamics within project teams affect the implementation of change orders. For example, hierarchical communication structures may hinder the timely escalation of critical issues, exacerbating delays and increasing bond liability. Contemporary debates surrounding change order clauses often revolve around the balance between standardization and customization. Proponents of standardized clauses argue that they provide clarity and consistency, reducing the likelihood of disputes. However, critics contend that standardized clauses may not adequately account for the unique complexities of individual projects, necessitating customization to address specific risks. Emerging technologies, such as digital contract management platforms, are transforming this landscape by enabling real-time tracking and analysis of change orders. These platforms leverage data analytics and artificial intelligence to identify patterns and predict potential disputes, offering a proactive approach to risk management. In conclusion, the intricate interplay between change order clauses, project dynamics, and bond liability demands a multifaceted approach that integrates legal, financial, and operational perspectives. By delving into the procedural, theoretical, and practical dimensions of change order management, surety underwriters can enhance their ability to navigate this critical aspect of contract analysis. This continuous exploration of change orders not only advances the understanding of bond liability, but also provides a foundation for developing more robust risk mitigation strategies. Termination for convenience and default clauses are among the most consequential provisions in construction and service contracts, governing how and under what circumstances a contract may be prematurely ended. These clauses define the rights and obligations of all parties in the event of termination, profoundly influencing project outcomes and, by extension, the risks borne by surety's underwriting performance and payment bonds. A comprehensive understanding of these clauses is essential for surety underwriters, as even seemingly minor variations in wording or interpretation can create substantial financial and legal exposure. Evaluating these provisions involves dissecting their structure, identifying potential pitfalls, and formulating strategies to mitigate bond liabilities. Termination for convenience clauses. Key characteristics and risks. Termination for convenience clauses allow one party, typically the project owner, to unilaterally terminate a contract without cause. These provisions, while offering flexibility to project owners, can present significant challenges to contractors and sureties. The clause is often justified as a safeguard against unforeseen circumstances, such as changes in project funding, regulatory hurdles, or shifts in organizational priorities. However, its implementation frequently disrupts contractor operations and creates financial uncertainties, particularly if termination occurs mid-project. From an underwriting perspective, one critical risk tied to termination for convenience is the compensation framework outlined in the contract. Contractors are usually entitled to reimbursement for work performed up to the termination date, as well as reasonable demobilization costs. However, vague or inadequately defined compensation terms can lead to disputes, prolonging the claims resolution process and increasing bond exposure. For instance, a contractor terminated for convenience may argue for reimbursement of anticipated profits on unperformed work, while the project owner might contest such claims, citing contractual exclusions. The surety, in turn, becomes entangled in the financial and legal fallout, often facing claims from both parties. Termination for default clauses, structure, and implications. In contrast, termination for default clauses are invoked when one party, usually the contractor, is alleged to have materially breached the contract. Default triggers can include failure to meet project milestones, substandard workmanship, or non-compliance with contractual terms. These clauses are more prescriptive than termination for convenience provisions, often detailing specific conditions under which termination is justified, as well as the procedures for notifying and remedying default. Default clauses carry inherent risks for sureties because a termination for default often precedes a bond claim. For example, if a contractor is terminated for failing to meet schedule requirements, the project owner may call upon the performance bond to engage a replacement contractor. The surety must then evaluate whether the default was legitimate and whether the termination procedures outlined in the contract were followed. Any deviation from procedural requirements, such as insufficient notice or failure to provide an opportunity to cure, can expose the surety to disputes, complicating the resolution process and increasing costs. Evaluating termination provisions. Underwriting pitfalls. Underwriting pitfalls associated with termination clauses often stem from ambiguous or overly restrictive language. In termination for convenience clauses, the absence of clear guidelines for calculating compensation can lead to protracted disputes. For example, a contract that fails to specify whether indirect costs, such as administrative overhead, are reimbursable creates opportunities for disagreement. Similarly, Termination for default clauses that lack detailed procedures for identifying and remedying default increase the likelihood of litigation, as contractors may challenge the validity of the termination. Another common pitfall is the inclusion of broad termination triggers that grant excessive discretion to project owners. Clauses allowing termination for vaguely defined reasons, such as unsatisfactory progress or failure to cooperate, create significant uncertainty for contractors and sureties. These provisions can be weaponized by project owners to terminate contracts prematurely, particularly in cases where projects encounter unforeseen difficulties or budget overruns. The resulting disputes not only delay project completion, but also expose the surety to substantial financial liability. Strategic insights for mitigating bond exposure. To mitigate risks associated with termination clauses, sureties must adopt a proactive approach to contract review and negotiation. One effective strategy is to advocate for the inclusion of clear and enforceable compensation terms in termination for convenience clauses. These terms should specify the categories of costs eligible for reimbursement, including direct labor, materials, and reasonable overhead. Additionally, underwriters should seek to limit the scope of reimbursable profits to work completed at the time of termination, thereby reducing the potential for inflated claims. For termination for default clauses, ensuring that the contract includes detailed procedures for identifying and remedying default is critical. This includes specifying the notice period required before termination, as well as the steps contractors must take to cure the alleged breach. By requiring project owners to document default in writing and provide contractors with a reasonable opportunity to address deficiencies, sureties can minimize the likelihood of disputes and enhance the enforceability of default terminations. Another key strategy involves the use of alternative dispute resolution, ADR mechanisms, such as mediation or arbitration, to resolve termination-related disputes. ADR processes are often faster and less adversarial than litigation, reducing the financial and reputational risks for all parties. Sureties should encourage the inclusion of ADR provisions in contracts, particularly for high-value or complex projects, where the stakes of termination disputes are significant. Historical context and theoretical frameworks. The evolution of termination clauses reflects broader changes in construction law and risk allocation practices. Historically, termination for default was the primary mechanism for ending contracts, rooted in the principle that breaches justified termination. However, the increasing complexity and unpredictability of modern construction projects have led to the widespread adoption of termination for convenience clauses, which offer greater flexibility, but also introduce new challenges. Theoretical frameworks, such as the principal-agent model, provide valuable insights into the dynamics of termination clauses. Under this model, the project owner, principal, and contractor, agent, operate with differing incentives, creating potential for conflict. Termination clauses serve as a mechanism for realigning these incentives, though their effectiveness depends on the clarity and enforceability of the contractual terms. Interdisciplinary connections and contemporary debates. Termination clauses intersect with multiple disciplines, including law, finance, and project management. Legal principles governing contract interpretation and enforceability play a central role in determining the validity of terminations, while financial analysis is critical for assessing the cost implications of termination. Project management practices, such as risk assessment and stakeholder communication, further influence the implementation of termination clauses, highlighting the need for an integrated approach. Contemporary debates often center on the balance between flexibility and accountability in termination provisions. Proponents of termination for convenience clauses argue that they provide essential safeguards for project owners, particularly in volatile economic or regulatory environments. However, critics contend that these clauses disproportionately favor project owners, creating significant risks for contractors and sureties. Similarly, debates over termination for default clauses often focus on the procedural safeguards necessary to protect contractors from arbitrary or unfair terminations. Emerging trends, such as the use of predictive analytics to identify potential defaults, are reshaping these debates by providing new tools for managing termination risks. These technologies leverage historical data and machine learning algorithms to predict contractor performance, offering valuable insights for underwriting decisions and contract negotiation. Liquidated damages clauses are a critical component of construction and service contracts, providing a pre-agreed mechanism for compensating project owners in the event of delays or performance failures. These clauses specify a monetary amount that the contractor must pay for each day of delay or for failing to meet specified milestones, serving as a financial safeguard against project overruns. However, the enforceability and implications of liquidated damages require a nuanced understanding of their legal and practical dimensions. For surety underwriters, these clauses represent a complex intersection of risk, proportionality, and bond obligations, with significant implications for claims and liability management. The foundations of liquidated damages: proportionality and enforceability. At the heart of any liquidated damages clause lies the principle of proportionality. For the clause to be enforceable, the damages specified must represent a reasonable estimate of the losses the project owner is likely to incur due to delays or non-performance. Courts generally uphold these clauses only when they reflect a genuine pre-estimate of harm, rather than serving as a punitive measure. This distinction is rooted in the legal principle that damages in contract law should compensate for actual losses, not punish the breaching party. For example, a clause stipulating an excessively high daily penalty, disproportionate to the actual costs of delay, may be deemed unenforceable, particularly if the project owner cannot demonstrate a clear connection between the damages and the losses incurred. The enforceability of liquidated damages clauses also depends on the clarity and specificity of their language. Ambiguities in defining the conditions that trigger liquidated damages can lead to disputes, complicating enforcement and increasing bond exposure. For instance, a clause that fails to account for delays caused by force majeure events, such as natural disasters or supply chain disruptions, may be challenged in court, leaving the project owner without recourse and the contractor vulnerable to unnecessary claims. Underwriters must assess the precision of these clauses to identify potential loopholes or ambiguities that could undermine their enforceability. Balancing contract compliance with bond obligations. For sureties, liquidated damages clauses introduce a dual challenge: ensuring that contractors comply with their contractual obligations while managing the financial risks associated with claims. When a project encounters delays, the invocation of liquidated damages can escalate bond liability, particularly if the contractor lacks the financial resources to pay the stipulated penalties. This is especially true in contracts with strict or punitive liquidated damages provisions, where the cumulative damages can quickly exceed the contractor's ability to pay. To balance these risks, underwriters must conduct a thorough review of the contractor's financial health and project management capabilities. This includes evaluating the contractor's track record of meeting deadlines, their cash flow reserves, and their capacity to absorb potential liquidated damages without jeopardizing project completion. Additionally, sureties should advocate for clauses that provide opportunities for mitigation, such as grace periods or negotiated reductions in damages for partial compliance. These mechanisms can help ensure that contractors remain incentivized to complete the project without facing insurmountable financial penalties. Practical implications and real-world scenarios. In practice, the enforcement of liquidated damages clauses often leads to disputes that test the limits of their proportionality and applicability. One common scenario involves project delays caused by factors beyond the contractor's control, such as late approvals from regulatory authorities or unforeseen site conditions. In these cases, project owners may still attempt to enforce liquidated damages, arguing that the contractor should have accounted for such risks in their project planning. Disputes of this nature often result in claims against the performance bond, as contractors seek financial relief from sureties to cover the penalties. Another frequent issue arises when liquidated damages clauses are applied inconsistently or selectively. For example, a project owner may choose to enforce the clause against one contractor while granting leniency to another, creating perceptions of unfair treatment and increasing the likelihood of litigation. Such practices not only strain contractor relationships, but also expose sureties to heightened liability, as they may be drawn into disputes over the fairness of enforcement. Historical context and theoretical frameworks. The concept of liquidated damages has its roots in Roman law, where predetermined penalties for breaches of contract were recognized as a means of providing certainty to both parties. Over time, common law systems refined the doctrine, emphasizing the importance of reasonableness and the prohibition of penalties. This evolution reflects broader trends in contract law, which prioritize the equitable allocation of risk and the avoidance of punitive measures. The theoretical underpinning of liquidated damages can be further explored through the economic theory of efficient breach, which argues that breaches should be allowed if the breaching party can compensate the non-breaching party while still achieving greater economic value. In this context, liquidated damages clauses function as a tool for quantifying compensation, enabling efficient resolution of disputes without resorting to protracted litigation. Interdisciplinary connections and emerging trends. Liquidated damages clauses intersect with multiple disciplines, including law, economics, and project management. Legal principles governing their enforceability are complemented by economic analyses of their impact on contractor behavior and project outcomes. For instance, excessively high liquidated damages may discourage contractors from bidding on projects, reducing competition and potentially increasing costs for project owners. Conversely, inadequately defined clauses can create moral hazard, as contractors may prioritize short-term cost savings over timely completion. Emerging trends in construction technology and data analytics are reshaping the implementation and enforcement of liquidated damages clauses. Predictive modeling tools, for example, enable project owners to estimate potential delays and their associated costs with greater precision, enhancing the accuracy of pre-agreed damages. Similarly, blockchain-based smart contracts offer the potential to automate the calculation and enforcement of liquidated damages, reducing disputes and ensuring compliance. However, these advancements also raise new questions about the balance between automation and discretion in contract management, highlighting the need for ongoing dialogue between stakeholders. In contemporary debates, the role of liquidated damages in promoting accountability versus creating financial strain remains a contentious issue. Proponents argue that these clauses incentivize contractors to meet deadlines and protect project owners from unforeseen costs. Critics, however, contend that overly rigid enforcement can lead to inequitable outcomes, particularly in cases where delays are caused by factors beyond the contractor's control. This tension underscores the importance of designing liquidated damages clauses that are both enforceable and equitable, balancing the interests of all parties while minimizing the risk of disputes. Force majeure provisions are a cornerstone of modern contract law, designed to address extraordinary events that render contractual performance impossible, impractical, or inadvisable. These clauses, rooted in principles of fairness and risk allocation, define the circumstances under which a party can be excused from its obligations without incurring liability. For contractors, force majeure provisions provide critical relief from delays or disruptions caused by unforeseeable events such as natural disasters, pandemics, geopolitical instability, or government interventions. However, these clauses also have significant implications for sureties, as they alter the risk landscape and influence the likelihood and resolution of bond claims. A comprehensive understanding of force majeure provisions and their impact on contractor obligations is essential for effective underwriting and contingency planning in industries prone to such risks. The scope and enforceability of force majeure clauses depend on their precise wording, which typically enumerates the specific events that qualify as force majeure. These events may include acts of God, such as hurricanes, earthquakes, or floods, as well as human-made disruptions like strikes, wars, or regulatory changes. The clause must also establish a clear causal link between the event and the contractor's inability to perform. For instance, if a hurricane disrupts supply chains but does not directly affect the construction site, a contractor's invocation of force majeure may be contested. Furthermore, most force majeure clauses include a notice requirement, obligating the contractor to inform the project owner of the event and its anticipated impact within a specified time frame. Failure to comply with this requirement can jeopardize the contractor's claim for relief, leaving the surety exposed to potential disputes. From a surety's perspective, force majeure risks intersect with bond responsibilities in several critical ways. Performance bonds, for example, guarantee the completion of a project in accordance with the contract terms, which may be rendered unachievable under force majeure conditions. When a contractor invokes force majeure, the surety must evaluate whether the event genuinely qualifies under the clause and whether the contractor has taken reasonable steps to mitigate its impact. This evaluation often involves analyzing the contractor's contingency planning, resource allocation, and communication with project stakeholders. For instance, a contractor affected by a supply chain disruption might mitigate delays by sourcing materials from alternative suppliers, demonstrating good faith and reducing bond liability. In payment bonds, force majeure events can complicate the relationship between contractors, subcontractors, and suppliers. Delayed payments resulting from project disruptions may trigger claims against the bond, even if the delays are excused under the force majeure clause. Sureties must navigate these claims carefully, balancing their obligations to subcontractors and suppliers with the protections afforded to the contractor under the clause. This often requires a nuanced understanding of the interplay between contract law and bond obligations, as well as close coordination with legal counsel and project stakeholders. Industries prone to natural disasters or geopolitical risks present unique challenges for underwriting, necessitating a proactive approach to risk assessment and mitigation. Best practices in these industries begin with a thorough review of the force majeure provisions in the underlying contract, ensuring that they are clearly defined, enforceable, and aligned with industry standards. For example, in regions vulnerable to hurricanes, contracts should explicitly address the impact of such events on project timelines, costs, and responsibilities. Underwriters should also consider the contractor's track record in managing force majeure risks, including their experience in similar projects, the robustness of their contingency plans, and their financial resilience. Geopolitical risks, such as wars or trade embargoes, require a different set of considerations. In these scenarios, force majeure clauses must account for the potential disruption of international supply chains, changes in regulatory environments, and heightened security concerns. Sureties must assess whether the contractor has established alternative supply chains, compliance protocols, and crisis management strategies to address these risks. Additionally, geopolitical risks often have long-term implications that extend beyond the immediate project, underscoring the importance of evaluating the contractor's broader operational and financial stability. Historical context provides valuable insights into the evolution of force majeure provisions and their application in modern contracts. The concept originated in French civil law, where it was codified as a principle of excused performance in cases of impossibility. Over time, common law jurisdictions adopted similar principles, emphasizing the importance of foreseeability and causation in determining the applicability of force majeure. The global COVID-19 pandemic further highlighted the critical role of these clauses, as courts around the world grappled with unprecedented disruptions to contractual performance. In many cases, the pandemic exposed gaps in traditional force majeure clauses, prompting a reevaluation of their scope and language to address emerging risks. From a theoretical perspective, force majeure provisions can be analyzed through the lens of risk management and behavioral economics. These clauses serve as a mechanism for reallocating risks that neither party can reasonably control, promoting fairness and stability in contractual relationships. However, the effectiveness of force majeure provisions depends on their ability to incentivize proactive risk management and prevent moral hazard. For instance, contractors who rely excessively on force majeure clauses as a safety net may be less motivated to invest in contingency planning, increasing the overall risk to the project. Interdisciplinary connections further enrich the analysis of force majeure provisions, drawing on insights from law, economics, and environmental science. Legal frameworks provide the foundation for understanding the enforceability of these clauses, while economic models shed light on their impact on project costs, timelines, and stakeholder relationships. Environmental science, in turn, informs the assessment of natural disaster risks, highlighting the importance of data-driven approaches to risk prediction and mitigation. For example, advances in climate modeling and geospatial analysis enable underwriters to identify regions and projects with heightened exposure to force majeure events, facilitating more informed decision-making. Contemporary debates surrounding force majeure provisions often center on their adaptability to emerging risks and technologies. Critics argue that traditional force majeure clauses are ill-equipped to address modern challenges such as cyber attacks, pandemics, and climate change, which require more nuanced and forward-looking approaches. Proponents, however, contend that these clauses remain a vital tool for managing uncertainty, provided they are regularly updated to reflect evolving risks. Emerging technologies, such as blockchain and artificial intelligence, offer new opportunities for enhancing the transparency and efficiency of force majeure management. Blockchain-based smart contracts, for instance, can automate the invocation and verification of force majeure clauses, reducing disputes and streamlining claims resolution. Meanwhile, artificial intelligence can analyze historical data and real-time inputs to predict the likelihood and impact of force majeure events, enabling more proactive risk management and contingency planning. In this evolving landscape, the role of sureties is more critical than ever, requiring a deep understanding of the interplay between force majeure provisions, contractual obligations, and bond responsibilities. By integrating historical, theoretical, and practical perspectives, underwriters can develop more robust strategies for managing these complex risks, ensuring the stability and resilience of projects in even the most challenging environments. Subcontractor default risk and pass-through liability represent critical vulnerabilities in construction contracts, where the performance and financial stability of subcontractors directly influence the obligations and exposures of primary contractors and sureties. Subcontractor provisions, including payment terms and flow-down obligations, create a complex web of interdependent relationships, requiring meticulous evaluation to identify and mitigate risks. For sureties underwriting performance and payment bonds, understanding these dynamics is paramount, as subcontractor failures can trigger cascading liabilities that disrupt projects, increase claims, and challenge the enforceability of contractual protections. At the core of subcontractor risk management lies the concept of flow-down obligations, which ensure that the terms of the primary contract extend seamlessly to subcontractors. These provisions are designed to create a unified framework of rights and responsibilities, aligning subcontractor obligations with the primary contractor's commitments to the project owner. For instance, flow-down clauses may require subcontractors to adhere to the same performance standards, timelines, and payment terms as outlined in the primary contract. While these clauses are essential for maintaining consistency across project tiers, their effectiveness depends on clear and enforceable language. Ambiguities in flow-down provisions can lead to disputes, particularly when subcontractors argue that certain terms were not explicitly communicated or agreed upon. Payment terms in subcontractor agreements are another critical area of focus. Most contracts utilize either pay when paid or pay if paid clauses, which dictate the timing and conditions of payments to subcontractors. Under a pay when paid clause, the subcontractor is entitled to payment within a reasonable time frame after the primary contractor receives payment from the project owner. In contrast, a pay if paid clause makes subcontractor payment contingent upon the primary contractor being paid, effectively transferring the risk of owner non-payment to the subcontractor. While pay if paid clauses offer greater protection for primary contractors and sureties, they are subject to legal challenges in certain jurisdictions, where courts may deem them unenforceable on the grounds of inequity. Sureties must evaluate the legality and enforceability of these clauses during the underwriting process, as they significantly influence the likelihood of payment bond claims. The impact of subcontractor default on primary contractor performance and bond exposure is profound, often creating a domino effect that jeopardizes project timelines, budgets, and stakeholder relationships. When a subcontractor defaults, whether due to financial insolvency, labor disputes, or material shortages, the primary contractor bears the responsibility for mitigating the disruption and completing the work. This often involves engaging replacement subcontractors, negotiating revised schedules, and absorbing additional costs, all of which increase the likelihood of performance bond claims. Moreover, subcontractor defaults can lead to disputes with the project owner, particularly if the default causes delays or compromises the quality of work. These disputes frequently escalate into litigation, further complicating the resolution process and increasing bond exposure. From an underwriting perspective, Crafting safeguards to address subcontractor default risk requires a multifaceted approach that integrates contractual, financial, and operational considerations. One effective strategy is to require pre-qualification of subcontractors based on their financial stability, technical expertise, and track record of performance. This process involves reviewing financial statements, credit reports, and references to ensure that subcontractors have the capacity to fulfill their obligations. Additionally, underwriters should encourage primary contractors to establish contingency plans for managing subcontractor defaults, such as maintaining a pool of pre-approved replacement subcontractors or securing additional insurance coverage for specific risks. Layered liability structures in construction projects further complicate the management of subcontractor risks. These structures arise when multiple subcontractors, suppliers, and service providers are engaged under a single contract, creating a hierarchical network of dependencies. For example, a subcontractor responsible for structural steelwork may rely on a supplier for raw materials and a separate service provider for fabrication. If any party in this chain defaults, the disruption cascades upward, affecting the primary contractor and, by extension, the surety. To address these complexities, underwriters must evaluate the interconnections among project participants, identifying potential bottlenecks and vulnerabilities that could exacerbate risks. This often involves conducting a detailed analysis of the project's supply chain, contractual relationships, and operational workflows. Historical context underscores the significance of subcontractor provisions and pass-through liability in construction law. The rise of subcontracting as a prevalent practice in the mid-20th century was driven by the increasing specialization and complexity of construction projects, which necessitated the involvement of multiple stakeholders with distinct expertise. However, this shift also introduced new risks, as primary contractors became increasingly reliant on subcontractors for critical aspects of project execution. Legal frameworks evolved in response to these changes, emphasizing the importance of clear and enforceable subcontractor agreements to minimize disputes and ensure accountability. Theoretical frameworks, such as the principal-agent model, provide valuable insights into the dynamics of subcontractor relationships. Under this model, the primary contractor acts as the principal, delegating specific tasks to subcontractors, agents, while retaining overall responsibility for project completion. This delegation creates potential for conflicts of interest, as subcontractors may prioritize their own objectives, such as maximizing profits or minimizing effort, over the broader goals of the project. Effective risk management strategies, including well-defined flow-down provisions and performance monitoring mechanisms, are essential for aligning subcontractor incentives with project outcomes. Interdisciplinary connections further enrich the analysis of subcontractor default risk and pass-through liability. Legal principles governing contract interpretation and enforceability intersect with financial analyses of subcontractor solvency and operational evaluations of project workflows. For instance, advances in construction technology, such as project management software and supply chain analytics, enable contractors and sureties to monitor subcontractor performance in real time, identifying potential issues before they escalate into defaults. Similarly, insights from behavioral economics shed light on the decision-making processes of subcontractors, highlighting the importance of incentives and penalties in promoting compliance and accountability. Contemporary debates surrounding subcontractor risk management often focus on the balance between flexibility and control in subcontractor agreements. Proponents of flexible terms argue that they foster collaboration and innovation, enabling subcontractors to adapt to changing project conditions. Critics, however, contend that excessive flexibility undermines accountability and increases the likelihood of disputes. Emerging trends, such as the use of blockchain technology to create transparent and immutable records of subcontractor performance, offer new opportunities for addressing these challenges. By providing a secure and verifiable audit trail of subcontractor activities, blockchain platforms can enhance trust and reduce the risk of disputes, benefiting all stakeholders. In navigating these complexities, sureties play a critical role in ensuring the stability and resilience of construction projects. By integrating historical, theoretical, and practical perspectives, underwriters can develop comprehensive strategies for managing subcontractor risks, addressing layered liabilities, and safeguarding bond obligations in an increasingly dynamic and interconnected construction landscape. Indemnity and hold harmless agreements are foundational elements in construction and service contracts, defining the allocation of risk and liability among parties. These provisions are particularly critical in managing the financial and legal responsibilities arising from claims, losses, or damages associated with a project. For surety underwriters, a deep understanding of indemnity clauses is essential, as these agreements directly influence the exposure and recoverability of bond claims. Practical insights into interpreting these clauses, including their limitations, overlaps with insurance coverage, and alignment with underwriting criteria, are necessary to assess their impact comprehensively and identify potential pitfalls. An indemnity clause, at its core, requires one party, the indemnitor, to assume financial responsibility for specific liabilities incurred by another party, the indemnitee. These clauses are designed to transfer risk, ensuring that the party best positioned to manage or control the risk bears the corresponding financial burden. The scope of indemnity can vary widely, from narrowly tailored agreements covering specific risks, such as property damage or third-party injuries, to broad, all-encompassing clauses that attempt to shift nearly all liabilities to the indemnitor. The enforceability of such broad clauses, however, often depends on jurisdictional limitations and public policy considerations, as courts may view overly expansive indemnity agreements as inequitable. One of the critical aspects of interpreting indemnity clauses is understanding their interaction with limitations on liability. These limitations may cap the indemnitor's financial exposure or exclude certain types of damages, such as consequential or punitive damages, from the indemnity obligation. For example, a clause that limits indemnity to direct damages arising from specific acts of negligence by the indemnitor provides a narrower scope of protection than one that covers all losses resulting from the indemnitor's work, regardless of fault. Surety underwriters must carefully evaluate these limitations to determine whether they align with the risk profile of the project and the contractor's ability to manage potential liabilities. Inadequately defined limitations can create gaps in protection, increasing the likelihood of disputes and claims against performance or payment bonds. The overlap between indemnity clauses and insurance coverage is another critical area of analysis. Many contracts require contractors to obtain liability insurance policies, such as commercial general liability (CGL) coverage, to complement indemnity provisions. These policies typically provide a financial backstop for indemnity obligations, covering losses arising from property damage, bodily injury, or other specified risks. However, conflicts can arise when indemnity clauses and insurance terms are misaligned. For instance, an indemnity clause that shifts liability for intentional acts or gross negligence to the indemnitor may not be covered by standard insurance policies, leaving the contractor exposed to significant financial risk. Surety underwriters must assess whether the contractor's insurance coverage adequately supports their indemnity obligations, ensuring that there are no coverage gaps that could undermine the contractor's financial stability or increase bond exposure. From an underwriting perspective, analyzing contractual indemnity terms for alignment with surety criteria involves several key considerations. First, underwriters must evaluate whether the indemnity obligations are proportionate to the contractor's financial capacity and risk management capabilities. Excessive indemnity burdens can strain a contractor's resources, increasing the likelihood of defaults and bond claims. Second, underwriters should review the indemnity clause for clarity and enforceability, ensuring that it does not contain ambiguous or overly complex language that could lead to disputes. For example, a poorly drafted indemnity clause that fails to specify the types of losses covered or the conditions under which indemnity applies may be subject to varying interpretations, creating uncertainty and legal challenges. Third, underwriters must consider the interplay between indemnity clauses and other contractual provisions, such as warranties, insurance requirements, and dispute resolution mechanisms, to ensure that the overall risk allocation framework is cohesive and balanced. Case studies of bond claims impacted by poorly negotiated indemnity agreements highlight the practical implications of these provisions. In one notable case, a contractor was required to indemnify a project owner for all losses arising from environmental contamination, including those caused by the owner's own negligence. When the project encountered unforeseen contamination issues, the owner sought indemnity from the contractor, leading to a performance bond claim. The contractor's failure to negotiate a limitation on indemnity for owner negligence resulted in significant financial strain, forcing the surety to step in and resolve the claim. This case underscores the importance of negotiating indemnity clauses that appropriately allocate risk and limit exposure. Another case involved a subcontractor's indemnity obligation to a general contractor for workplace injuries sustained by a subcontractor's employee. Although the subcontractor carried CGL insurance, the policy excluded coverage for employee injuries, leaving the subcontractor personally liable for the indemnity claim. When the subcontractor defaulted on its obligation, the general contractor filed a claim against the payment bond, arguing that the indemnity obligation constituted an unpaid contractual debt. This dispute illustrates the critical role of insurance alignment in mitigating indemnity-related risks and highlights the need for comprehensive pre-qualification and risk assessment processes. Historical context provides insight into the evolution of indemnity and hold harmless agreements, which have their origins in early common law principles of risk allocation. These agreements were initially used to manage liabilities in maritime and transportation contracts, where risks were often unpredictable and difficult to control. Over time, indemnity clauses became a standard feature of construction contracts, reflecting the increasing complexity and specialization of modern projects. The development of statutory and judicial limitations on indemnity, such as anti-indemnity statutes in certain jurisdictions, further shaped the landscape, emphasizing the need for balanced and equitable risk allocation. Theoretical frameworks, such as economic theories of risk transfer and behavioral insights into contract negotiation, enrich the analysis of indemnity provisions. Risk transfer theories suggest that indemnity clauses are most effective when the party assuming the risk has both the capacity and incentive to manage it efficiently. Behavioral insights, on the other hand, reveal how cognitive biases, such as overconfidence or anchoring, can influence the negotiation and acceptance of indemnity obligations, sometimes leading parties to underestimate the potential consequences of their agreements. Interdisciplinary connections further illuminate the complexities of indemnity and hold harmless agreements. Legal principles governing contract interpretation and enforceability intersect with financial analyses of contractor solvency and operational assessments of project risks. Advances in data analytics and predictive modeling enable underwriters to evaluate indemnity risks with greater precision, identifying patterns and correlations that inform decision-making. For example, historical data on claims arising from similar projects or indemnity terms can provide valuable benchmarks for assessing the likelihood and severity of potential liabilities. Contemporary debates surrounding indemnity agreements often focus on their fairness and efficiency in allocating risks. Critics argue that broad or one-sided indemnity clauses can create inequitable burdens, particularly for smaller contractors with limited resources. Proponents, however, contend that indemnity provisions are essential for managing complex risks in large-scale projects, provided they are carefully crafted and supported by adequate insurance coverage. Emerging trends, such as the use of blockchain-based smart contracts to automate indemnity enforcement, offer new opportunities for enhancing transparency and reducing disputes. These technologies enable real-time tracking of indemnity obligations and provide secure, verifiable records of performance, facilitating more efficient claims resolution. In this intricate and evolving landscape, the role of sureties is pivotal, requiring a deep understanding of the interplay between indemnity provisions, insurance coverage, and bond obligations. By integrating practical, theoretical, and historical perspectives, underwriters can navigate these complexities effectively, ensuring that indemnity agreements align with project risks, contractor capabilities, and the overarching goals of risk management in construction and service contracts. Dispute resolution clauses are integral to construction and service contracts, governing the mechanisms by which disagreements are addressed and resolved. These clauses delineate whether disputes will be settled through arbitration, mediation, litigation, or a combination of these methods, shaping not only the speed and cost of resolution, but also the ultimate impact on bonding processes. For surety underwriters, the implications of these clauses extend deeply into the bond claim process, influencing the timeline, cost, and enforceability of claims. Understanding the nuanced interaction between dispute resolution mechanisms and bond obligations is essential to effectively assess jurisdictional and procedural risks while safeguarding against delays and uncertainties caused by conflicting or ambiguous provisions. Arbitration clauses, often favored in construction contracts for their perceived efficiency and confidentiality, require parties to submit disputes to a neutral arbitrator whose decision is binding. While arbitration typically avoids the lengthy timelines associated with court litigation, it can pose unique challenges for sureties. For example, arbitration proceedings are less predictable than litigation due to limited discovery and appeal options, potentially exposing sureties to unexpected outcomes. Moreover, many contracts require the surety to honor arbitration awards as part of their bond obligations, even if the surety was not a party to the arbitration agreement. This creates a layer of risk, as the surety may have limited ability to influence the proceedings or contest the arbitrator's decision. Mediation, on the other hand, is a non-binding process that emphasizes negotiation and compromise under the guidance of a neutral mediator. While mediation is generally faster and less adversarial than both arbitration and litigation, its effectiveness depends on the willingness of parties to cooperate and reach a settlement. For sureties, mediation offers the advantage of preserving relationships and minimizing legal costs, but it may not always resolve disputes definitively, leaving the door open for subsequent arbitration or litigation. In cases where mediation fails, the unresolved issues can create prolonged delays in bond claim resolution, complicating the surety's ability to fulfill its obligations in a timely manner. Litigation, the most formal and adversarial dispute resolution method, involves resolving disputes through the court system. While litigation provides a comprehensive framework for evidence gathering, cross-examination, and appellate review, it is often criticized for its high costs and extended timelines. For bond claims, litigation can be particularly burdensome, as it may delay project completion and increase the financial exposure of all parties involved. Sureties must be prepared for the possibility of protracted legal battles, especially in cases where jurisdictional challenges or conflicting contractual provisions arise. The interaction between these dispute resolution mechanisms and bond claim processes is further complicated by jurisdictional and procedural risks. Jurisdictional risks stem from the geographic or legal boundaries within which disputes are resolved. For instance, a contract requiring disputes to be arbitrated in a foreign jurisdiction may impose significant logistical and financial burdens on contractors and sureties, increasing the overall risk of the project. Similarly, procedural risks arise when dispute resolution clauses fail to specify critical details, such as the governing law, venue, or rules of arbitration or mediation. Ambiguities in these areas can lead to disputes over the interpretation and enforceability of the clauses themselves, further delaying resolution and escalating costs. To mitigate these risks, underwriters must adopt a proactive approach to evaluating dispute resolution clauses. This begins with a detailed review of the contract to ensure that the clauses are clear, enforceable, and aligned with the interests of all parties, including the surety. Key considerations include the specificity of the clause language, the fairness and neutrality of the chosen venue, and the compatibility of the dispute resolution process with the project timeline and risk profile. For example, contracts that mandate arbitration should clearly define the rules and procedures governing the process, including the selection of arbitrators, the scope of discovery, and the timeline for issuing a final award. Similarly, mediation clauses should specify the qualifications and selection process for mediators, as well as the steps to be taken if mediation fails to produce a settlement. Real-world examples highlight the challenges posed by unclear or conflicting dispute resolution provisions. In one case, a construction contract included both an arbitration clause and a litigation clause, without clarifying which method would take precedence in the event of a dispute. When a dispute arose, the parties spent months litigating the enforceability of the arbitration clause before addressing the underlying issues, delaying the resolution of bond claims and escalating costs for all stakeholders. This example underscores the importance of ensuring that dispute resolution clauses are not only clear and unambiguous, but also internally consistent and well integrated with the overall contract structure. Another example involved a contract requiring disputes to be resolved through arbitration under the rules of a specific arbitral institution. However, the contract failed to specify the venue for arbitration, leading to a jurisdictional dispute that further delayed proceedings. In this case, the project owner filed a performance bond claim against the surety, arguing that the contractor's inability to resolve the dispute constituted a breach of contract. The surety was forced to navigate the complex interplay between the unresolved dispute and its bond obligations, ultimately incurring significant costs to address the claim. The historical development of dispute resolution clauses reflects broader trends in contract law and commercial practice. Early construction contracts often relied exclusively on litigation to resolve disputes, reflecting the formal legal frameworks of the time. However, as projects became more complex and globalized, alternative dispute resolution mechanisms such as arbitration and mediation gained prominence, offering faster and more flexible solutions tailored to the unique challenges of the construction industry. The rise of international arbitration, in particular, has facilitated cross-border projects by providing a neutral forum for resolving disputes, although it has also introduced new jurisdictional and procedural complexities. The theoretical foundations of dispute resolution clauses can be analyzed through the lens of game theory and negotiation principles. Arbitration and mediation, for example, can be seen as mechanisms for incentivizing cooperation and minimizing the costs of conflict, aligning the interests of parties toward a mutually beneficial resolution. Litigation, by contrast, represents a zero-sum game in which the outcome is determined by the relative strength of each party's legal position. Understanding these dynamics is essential for crafting dispute resolution clauses that balance fairness, efficiency, and enforceability. Interdisciplinary connections further enrich the analysis of dispute resolution clauses and their bonding implications. Legal expertise is critical for interpreting the enforceability and implications of these clauses, while insights from economics and behavioral science shed light on the incentives and decision-making processes of parties in conflict. Advances in technology, such as online dispute resolution platforms and artificial intelligence-driven case analysis, are reshaping the landscape of dispute resolution, offering new tools for streamlining processes and reducing costs. For example, virtual arbitration and mediation sessions enable parties to resolve disputes remotely, increasing accessibility and efficiency while reducing the logistical challenges of traditional methods. Contemporary debates surrounding dispute resolution clauses often focus on their adaptability and fairness in an increasingly complex and dynamic construction environment. Proponents of alternative dispute resolution mechanisms argue that they offer faster, more cost-effective solutions than traditional litigation, while critics contend that these mechanisms can lack transparency and procedural safeguards. Emerging trends, such as the integration of blockchain technology to create immutable records of dispute resolution proceedings, offer new opportunities for enhancing accountability and trust, although they also raise questions about privacy and data security. In this intricate and evolving landscape, sureties play a pivotal role in navigating the complexities of dispute resolution clauses and their implications for bond claims. By integrating historical, theoretical, and practical perspectives, underwriters can develop comprehensive strategies for evaluating and managing these clauses, ensuring that they align with the overarching goals of risk mitigation and project success. Scope of work analysis is a fundamental component of contract management, particularly in construction and service industries, where the success of a project hinges on the clarity and precision of the defined scope. For surety underwriters, the implications of scope definition extend directly to performance bond liability, as ambiguities or misalignments in the scope can create significant risks of default, disputes, and claims. Ensuring scope clarity requires rigorous analysis, comprehensive risk assessment, and proactive management strategies, particularly in the context of poorly defined or evolving project parameters. These efforts mitigate performance bond exposure by aligning contractor qualifications with project requirements, reducing the potential for miscommunication and mismanagement. At its core, a well-defined scope of work provides a detailed roadmap of the tasks, deliverables, and responsibilities required to complete a project. It establishes clear expectations for all parties, minimizing the likelihood of misunderstandings or conflicts. Techniques for ensuring scope clarity include the use of detailed descriptions, measurable milestones, and unambiguous performance standards. For instance, a scope of work document for a construction project might specify the type and quantity of materials, the dimensions and specifications of the finished structure, and the timeline for each phase of the project. Incorporating measurable criteria, such as performance metrics or quality benchmarks, ensures that all parties have a shared understanding of what constitutes successful completion. One of the most significant risks associated with poorly defined scopes of work is the misalignment between project requirements and contractor qualifications. When a contractor lacks the technical expertise, resources, or experience to fulfill the scope, the likelihood of performance issues increases dramatically. For example, a contractor with experience in residential construction may struggle to meet the demands of a large-scale commercial project involving advanced structural engineering. This misalignment not only jeopardizes project success, but also increases the risk of performance bond claims, as the surety may be called upon to step in and address the contractor's deficiencies. To mitigate this risk, underwriters must evaluate the contractor's qualifications during the bonding process, considering factors such as prior experience, technical capabilities, and financial stability. Additionally, underwriters should assess whether the scope of work is realistic and achievable within the contractor's capacity, ensuring that the project is not overscoped relative to available resources. Scope expansions, often driven by change orders or unforeseen project developments, present another critical challenge for underwriters. When the scope of work evolves during the course of a project, it can introduce new risks and liabilities that were not accounted for in the original contract or bond. Poorly defined scope expansions, in particular, can lead to disputes over cost increases, timeline adjustments, and quality expectations. For instance, a change order requiring the addition of a new structural component may disrupt the contractor's workflow, delay project completion, and create additional costs that strain the contractor's financial resources. These challenges are further compounded when the scope expansion is not clearly documented or agreed upon by all parties, creating ambiguities that can escalate into legal disputes. Risk management strategies for dealing with scope expansions begin with proactive contract management and communication. Underwriters should encourage the inclusion of robust change order processes in contracts, ensuring that any modifications to the scope are thoroughly documented and approved by all relevant parties. This includes specifying the conditions under which change orders may be issued, the procedures for evaluating and approving changes, and the mechanisms for resolving disputes over scope adjustments. Additionally, underwriters should assess whether the contractor has adequate contingency plans and resources to manage scope expansions without compromising performance. This may involve reviewing the contractor's financial reserves, staffing capacity, and access to specialized expertise. The historical evolution of scope of work practices reflects the increasing complexity and specialization of modern projects. In the early 20th century, contracts often relied on general descriptions and broad performance standards, leaving significant room for interpretation. Over time, the rise of project management methodologies, such as the critical path method and earned value management, introduced more precise techniques for defining and monitoring scope. These advancements emphasize the importance of detailed planning, accountability, and performance measurement, laying the groundwork for contemporary practices in scope analysis and management. Theoretical frameworks, such as systems theory and risk management theory, provide valuable insights into the dynamics of scope definition and performance risk. Systems theory emphasizes the interconnectedness of project components, highlighting how changes in one area of the scope can ripple through the entire project, affecting timelines, costs, and outcomes. Risk management theory, on the other hand, focuses on identifying, assessing, and mitigating uncertainties that arise from scope ambiguities or misalignments. By integrating these perspectives, underwriters can develop more effective strategies for managing scope-related risks and ensuring alignment with performance bond obligations. Interdisciplinary connections further enhance the analysis of scope of work and performance bond implications. Legal principles governing contract interpretation and enforceability intersect with financial analyses of project budgets and operational assessments of contractor capabilities. Advances in technology, such as building information modeling, BIM, and project management software, enable more precise and dynamic scope definition, providing real-time insights into project progress and risks. For example, BIM tools allow contractors and project owners to visualize and simulate the project scope, identifying potential conflicts or gaps before construction begins. These technologies not only improve scope, the interplay between insurance requirements and bonding obligations is a critical area of analysis in contract risk management, particularly in industries like construction and engineering, where financial liabilities and exposures are significant. Insurance and bonds are complementary instruments, each designed to mitigate distinct risks. Yet their terms often overlap in ways that require careful coordination. For surety underwriters, reviewing insurance clauses for alignment with bond underwriting standards is an essential step in ensuring that all potential risks are appropriately managed without creating redundancies or gaps that could expose the surety to unnecessary claims. The task involves a detailed examination of contractual provisions, identification of potential conflicts, and the implementation of strategies to harmonize the relationship between insurance and bonding requirements. Insurance clauses in construction contracts typically specify the types and levels of coverage that contractors must maintain to protect against various risks. Common requirements include commercial general liability, CGL, insurance to cover third-party claims for property damage or bodily injury, professional liability insurance for design errors or omissions, and workers' compensation insurance to address employee injuries. These policies often complement the protection provided by performance and payment bonds, which guarantee the contractor's fulfillment of contractual obligations. However, gaps in insurance coverage, whether due to insufficient limits, excluded risks, or poorly defined terms, can shift liabilities onto the surety, increasing the likelihood of bond claims. One critical area of analysis is the alignment between insurance and bond obligations. For example, a contract may require the contractor to indemnify the project owner for damages arising from construction defects, while also mandating that the contractor's insurance policy covers such damages. If the insurance policy includes exclusions for certain types of defects or limits coverage to specific causes of loss, the surety may become the default source of recovery for claims that fall outside the policy's scope. To mitigate this risk, underwriters must assess whether the required insurance coverage aligns with the project's risk profile and whether the contractor's policies adequately support the indemnity and performance bond provisions. This involves scrutinizing policy exclusions, coverage limits, and endorsement requirements to ensure there are no gaps that could create undue exposure for the surety. Another area of concern is the interaction between contractual insurance requirements and the terms of the bond. For instance, payment bonds often guarantee that subcontractors and suppliers will be paid for their work, but disputes can arise if insurance claims are also filed for damages related to non-payment or contract breaches. In one scenario, a subcontractor might file a claim under the contractor's CGL policy for damages caused by delayed payment while simultaneously pursuing a payment bond claim against the surety. Such conflicts not only complicate the resolution process, but also increase the financial and administrative burden on all parties involved. Underwriters must anticipate these scenarios by ensuring that contractual provisions clearly delineate the responsibilities of the contractor, the insurer, and the surety, minimizing the potential for overlapping claims. Practical examples illustrate the challenges of managing conflicts between insurance and bond terms. In one case, a contractor's professional liability policy excluded coverage for design errors caused by subcontractors, even though the performance bond guaranteed the overall quality of the project. When a subcontractor's design error led to significant structural issues, the project owner filed a claim against the performance bond, arguing that the contractor was ultimately responsible for the error. The surety was forced to address the claim despite the existence of an insurance policy that should have provided coverage. This case highlights the importance of aligning insurance requirements with bonding obligations to ensure that all parties understand their roles and responsibilities in managing project risks. Another example involved a dispute over property damage caused by a subcontractor's negligence. The contract required the subcontractor to maintain CGL insurance and indemnify the contractor for any resulting claims. However, the insurance policy's deductible was so high that the subcontractor was unable to cover the cost, leaving the contractor and the surety exposed to the financial consequences. The surety ultimately had to resolve the claim under the performance bond, underscoring the need for underwriters to evaluate not only the existence of insurance coverage, but also its practical adequacy in addressing potential liabilities. The historical evolution of insurance and bonding practices reflects a growing recognition of the need for integrated risk management strategies. Early contracts often relied on bonds as the primary means of financial protection, with insurance playing a secondary role. Over time, the increasing complexity of projects and the rise of specialized insurance products have shifted this dynamic, creating a more interconnected relationship between the two instruments. Today, the challenge lies in navigating this relationship to ensure that each instrument complements the other without creating redundancies or conflicts. Theoretical frameworks such as risk transfer and allocation theories provide valuable insights into the design and evaluation of insurance and bonding provisions. These frameworks emphasize the importance of assigning risks to the parties best equipped to manage them, whether through financial resources, technical expertise, or operational control. For instance, insurance is often best suited to address risks that are random and unforeseeable, such as accidents or natural disasters, while bonds are more effective in managing risks tied to performance and contractual compliance. Understanding these distinctions is crucial for crafting contractual provisions that balance the interests of all stakeholders while minimizing overall project risk. Interdisciplinary connections further enhance the analysis of insurance and bonding interactions. Legal principles governing contract interpretation and enforceability intersect with financial analyses of policy terms and operational assessments of project risks. Advances in data analytics and risk modeling enable underwriters to evaluate the probability and impact of claims with greater precision, identifying areas where insurance and bonding provisions may overlap or conflict. For example, predictive analytics can help underwriters assess the likelihood of claims arising from specific project conditions, such as high-risk construction methods or adverse environmental factors, allowing for more targeted adjustments to contractual requirements. Contemporary debates surrounding insurance and bonding interactions often focus on their adaptability to emerging risks and changing regulatory landscapes. Proponents of greater integration between insurance and bonding argue that this approach can streamline claims processes and reduce administrative burdens, while critics caution that excessive reliance on one instrument may undermine the effectiveness of the other. Emerging trends, such as the use of parametric insurance to address specific project risks, offer new opportunities for innovation, but also raise questions about their compatibility with traditional bonding practices. In navigating these complexities, sureties play a critical role in ensuring that insurance and bonding provisions are aligned, comprehensive, and effective in managing project risks. By integrating historical, theoretical, and practical perspectives, underwriters can develop strategies to address potential gaps, conflicts, and redundancies, safeguarding the interests of all parties while maintaining the stability and integrity of the project.